You're like a government bond, stable, risk-free, and always there for me. Government bonds are a very crucial asset as they assist in funding deficits of the government budget and are used to raise capital for various projects such as infrastructure spending. Hey, this is Harsh, and I welcome you all to our knowledge series by SMEST Discover, where you can get smart about investing. Now let's understand the dynamic government debt market. The government securities market is the most active segment of the Indian fixed income market. The GSEC debt market provides benchmark interest rates for pricing of various financial instruments. So let's start with the issuance of government bonds. In very simple terms, it refers to the process by which the government borrows money from investors by issuing bonds to pay interest and principal at a future date. Sounds pretty simple, right? But yeah, there's more to it. In June of 1992, the GOI introduced an auction of dated securities, thus making its borrowing at a predetermined market rate. The auction process ensures the most efficient price or yield. The RBI generally issues an indicative auction calendar in the month of March and September for the next 6 months after seeking approval from the government. This gives the market a broad idea of the expected quantum of borrowing, the auction dates, and the tenure of securities. Now you might be wondering how this auction works. Well, an auction for dated securities is normally conducted on Fridays with the underwriting auctions for primary dealers on the preceding day with the settlement on Mondays. You can see the diagrammatic representation of the auction process for dated GSECs on your screen for better understanding. The RBI decides the appropriate auction type based on market conditions and informs the market about the same in advance irrespective of auction notification. Let's look at the various types of auctions currently being conducted by the RBI. So the first one is yield-based auction. This is generally conducted for a new security. The investors bid in yield terms up to 2 decimal places. For example, 5.77% or 5.79%. The bids are arranged in an ascending order and the cutoff yield arrived at the yield corresponding to the notified amount of the auction. The cutoff yield gets set as the security's coupon rate. The bids higher than the cutoff yield are rejected. The second is price-based auction. This is used for reissuance of existing securities. The bidding is in terms of price for the par value of the security. For example, 105, 103, these are the price per 100. The bids are arranged in a descending order and the ones that are below the cutoff price are rejected. Furthermore, auctions are classified as multiple or uniform price auctions based on the price paid by successful bidders. When all the successful bidders are required to pay at the auction cutoff price, it is a uniform price auction. While when successful bidders pay at par at respective price or yield at which they have bid, it is termed as a multiple price auction. The choice of multiple versus uniform price auction is made by the RBI based on the market conditions. The minimum bid amount is Rs 10,000 and in multiples of Rs 10,000 thereafter. Auction participants can bid under 2 categories based on their eligibility. The first one is competitive bidding. It is meant for well-informed institutional investors where they bid at a specific price or yield and get allotment if their bids are within the cutoff price or yield. Such participants include banks, primary dealers, insurance companies, financial institutions, and even mutual funds. They can put in multiple bids at various prices or yields. The second one is a non-competitive bidding. These are specially provided for retail investors like you and me. Non-competitive bidding is open for participants who do not have a current or an SGL account with the RBI and submit their bid directly through an aggregator or facilitator such as a scheduled bank, a primary dealer, and specified stock exchanges. SGL accounts are meant to hold GSEC of the entities who own the securities and the same is maintained at RBI. Constituents maintain a sub-account called Constituent SGL account with an SGL service provider. Now let's talk about the second most important aspect of it, trading. The secondary market for GSEC in India is very active and the infrastructure for trading and settlement is one of the best in the world. First, let's learn about the gilt account. CSGL or gilt account are a demat form of holding government securities with the RBI, just as an investor can hold shares in demat form with a depository participant. Retail investors like you can open a gilt account, which is known as a retail direct account, and for delivery of the security, he has an option to choose between a demat or gilt account. Now, the delivery of GSEC in a demat generally takes around 15 days, so a gilt account is usually preferred. Secondary market trading takes place through a negotiated dealing system order matching. Well, the name might sound complicated to you, right? But the purpose is very simple. The NDSOM is an electronic trading platform used for trading government securities in India. In the August of 2005, RBI introduced an anonymous screen-based electronic order matching module, which is known as the NDSOM. Participants place orders of bid for purchase or offer for sale or a two-way quote for the desired security with amount and price on the NDSOM, which matches such inter-entity bids and offers of the same prices with a time priority. Now, once these orders are matched, the trade details, they flow seamlessly from trading to settlement with a straight-through process of framework of the Clearing Corporation of India Limited, which is the clearing and settlement house for government securities. The second is known as the over-the-counter market. Now, this is a decentralized market where bonds are traded directly between two parties, executed outside the exchange, and it takes place through the broker network, and can also be done over telephonic negotiations with a bank, primary dealer, financial institution, either directly or through a SEBI-registered stockbroker like SMEST. All such trades have to be reported on the exchange within 15 minutes of striking a deal. Now, coming to the clearing and settlement process. The Clearing Corporation of India was set up in April 2001 for clearing and settlement of all secondary market trades of GSEC. The CCIL also guarantees the settlement through the process of novation, whereby it becomes the central counterparty for every trade. What this means is, it becomes the seller for each buyer and the buyer to each seller. CCIL forwards the settlement file containing the obligations for both securities and funds to the RBI, where settlement takes place by simultaneous transfer of securities and funds. Now, during this settlement process, if any participant fails to provide securities or funds, the same has to be provided by CCIL by the counterparty. CCIL collects margins from all participants and it maintains a settlement guarantee fund for this purpose. So all outright secondary market GSEC trades are settled on a T1 basis. Well, I hope today's video did bring you a step closer towards being smart about investing. We hope you are excited to start your investment journey. Visit SMEST.in and take the next step towards investing wisely. Comment below and share what's the most interesting thing you found out today. But before signing off, always remember, investment in debt securities are subject to market risks. Please read all offer-related documents carefully. I'll see you in the next video.